I'm John Gatewood, founder and CEO of Gatewood Wealth Solutions, where we are on a mission to help individuals and families become and remain financially self-reliant so they can give purpose to their money. So welcome back to our weekly Market Insights broadcast. Every Wednesday, we cover this week's top news stories related to the market, economy, and your portfolios, so you can be better informed when making decisions about your money. And with me today, once again, is Aaron Tuttle, our Chief Investment Officer. Welcome back, Aaron.
John, I'm glad to be here.
Boy, we have some fun things to talk about because there was a great phenomenon that we saw happen this week.
The GameStop?
The GameStop.
I've heard a couple of things about that.
I don't want to give it away yet, but one good piece of news is that...
Stop with the games now.
I'll stop with the games. One thing that's not a game is that the coronavirus cases are continuing to decline. I think that's good for the economy, which will be good for the market.
Yes.
But last week we were talking about the tax deadlines. I thought that might be a good thing for us just to review because these things are relevant right now.
So most of the most accounts should already have their 1099s out. For those accounts that have a security, it just takes one to delay the reporting. They will go out every Friday on it through February. There will be a draft sent out on February 19th, and whenever they looked at the accuracy, they were accurate 0.7%. Or there was inaccuracies 0.7% of the time, so 99.3% likeliness that statement is a good one, so please provide that to your accountant, but certainly wait to file until that 1099, the official one, comes through.
So let's talk about the stimulus package, because we thought that was going to be passed relatively quickly, but seems like there's some pushback here.
So it's still within the February-March time frame on the stimulus package. The initial $1.9 trillion that President Biden had requested was, as we had said, more of a negotiating tactic. And then now there's been some pushback by some Republicans. It's still going through. What it looks like, we go back to that Goldman Sachs analysis that it's probably around $1 trillion to $1.1 trillion. But as you had mentioned, it continues to move on. President Biden wants to get this through by using 60 votes, which is the normal way to pass the stimulus, and avoid using reconciliation. There are 50 Democrats. That means he needs 10 Republicans. He did meet with those 10 Republicans, and the meeting was constructive, but they're requesting a $618 billion bailout. So what's the difference there? Well, there's some lower checks. So instead of $1,400, it would be $1,000, and they would also tighten the income requirements. So likely that if you are doing well financially, you're not going to receive a $1,000 stimulus check.
Would this impact at all the forecast that we have for the market?
No. We've been assuming somewhere around $1 trillion on the stimulus, and we think the $618 billion is more of a negotiation. The big ticket item is the state and local government, $350 billion that has been set aside to help them through this pandemic. The media has pointed out there are a lot of Republican governors that want this to go through. I don't know that that's a great reason to do it, because if you wanted to send me billions of dollars, I'd say yes too. So I don't know that necessarily is a great argument on why it'll get done, but there will be something there. As the Republicans had reminded Democrats in the previous Congress, elections have consequences. Well, they can just come back and say elections have consequences. They could go through with a reconciliation. If they can't bridge this gap, 618 to 1.9, and come to a middle, most likely it'll go through reconciliation. However, you still need West Virginia Senator Manchin to approve. He is the more conservative Democrat out of West Virginia, and he wants a bipartisan approach, but he said that he would sign off on the $1.9 trillion. His issue is the $15 minimum wage. West Virginia being one of the more lower income states, they would be hurt more than other states, let's say New York, with a very high minimum wage, and they're already battling unemployment. So that's kind of where we are. There are some Democrats that say they want to just completely ignore the reconciliation rules and bring the minimum wage into the bill. That would probably set a pretty bad precedent to ignore longstanding rules that have already been agreed to by the parliamentarians in Congress. So
I think the argument that we hear on the other side, though, is that by raising the minimum wage, people that are not employed, or when they get employed, they'll be making more money.
There are certainly people that win out. So let's just take McDonald's. I think that's one that we can all kind of associate this debate with. If they were to increase the wage to $15, what's McDonald's going to do? They're going to increase the production capacity by bringing on kiosks and other technology to make the remaining employees far more productive. You have to produce more income than what it costs the company for you to have viable employment. So the person that was making it's probably $10 to $13 an hour, somewhere in there. They were already getting close to that $15 an hour wage. We'll see an increase, but then there's going to be people laid off as that production capacity is added on. And this is, though there are people that know economics well and know the actual ramifications, and they'll point to some studies that will counteract some of this. It is a complex factor, but if you just do a priori logic, there will be more unemployment if you raise the cost of wages than there would have been if you would not have increased the wages. So this is a known phenomena. Most people are well above that, are not going to be affected whatsoever, and you don't necessarily see price increases, as the example with McDonald's, right? The kiosks could actually lower some of the salary costs, but it's hampering the market. It is what it is for a reason. And messing with that will have unintended consequences that you did not like.
As I mentioned at the beginning of the broadcast, questions that we've been getting this week were about GameStop and what is going on, because they haven't seen something like this. This is something fundamental in the market. So can you walk us through how this works?
So these things have happened before. It definitely has caught the attention of a lot of people. It's been a fun story, and the story is that it's this David and Goliath type of story, the underdog story. Everyone loves the underdog story, right?
Always.
So always. I'm a big fan. I'm behind Wall Street bets. I think it's fun. It's exciting. Obviously, not everyone thinks that, especially Melvin Capital, where there's these retail investors, and they're all using this new app, Robinhood, and they're the Reddit army by going through their social media programs and coordinating. And they've just defeated the Goliath, Melvin Capital, with the stone of the short squeeze on GameStop. And it's a fun story. But I would say that this is a myth.
So what do you mean it's a myth?
Yeah, it's going to take us a while to get to why myth this. We're going to go over several myths, but the whole presentation will explain why this David and Goliath, this underdog story, really isn't exactly what is happening. And we're going to get into that. And to do that, we got to understand that there are a lot more players that are behind the scenes that are doing things, and they're not necessarily nefarious. To really understand that story, it's not just these Robinhood investors.
Well, let's talk about who these players are.
Yeah, we'll get into that. But first, I think it's really important to understand what is short selling. I think we all are familiar with how you make money in stock, right? You buy low and you sell high.
Right.
And we try to do that as often as possible, and that's how you make money in stock. Well, you can do the exact opposite, where you sell high and buy low, and if they're the same dollar amounts where you sold and then you bought back as when you bought and you sold, you're going to net the same amount of money. So you can make money in stocks either way, and there's nothing nefarious or illegitimate about that process. It's part of the price discovery that is used in markets that is vital and important for how the market operates. So yes, there may be people speculating on that price, but that is information that's getting brought into the market.
So what does it mean when we say somebody shorts a stock?
Right, so the only way that you could sell the stock is if you have possession of it. And typically, if you don't like the stock, you don't already have possession of it. So what do you do if you want to short a stock? So we have somebody that's long the stock. They have the stock in their account. You have somebody that wants to sell it short, and then you have the broader market. So the first step is the short seller needs to borrow the stock from the person that has the long position, the owner of the stock. Now, if you have a company and you like the company and you think it's going to go higher, are you really wanting to loan your stock to an individual just because they don't like the price and they want to sell it down? Probably not. You need to have some type of incentive that you will release that stock. So if you do like the stock and you think it's going to appreciate, and this guy over here thinks it's going to go down, you say, you know what? I'll let you borrow my stock, but you got to pay me some type of fee.
Right. I'm not going to give up possession of it, or at least loan it out unless I have some type of interest.
Right, and
Just
that
like
way,
mortgage on a home.
that way, not only do you get the appreciation of the stock that you think is going to happen, you get to collect some interest on the way too, right? So that would be what incentivizes someone to allow their stocks to be short or sold short. So one of the things we haven't seen often talked about in the media, and one of the reasons this story is lacking some information on that myth, is you can't just go sell a stock and it be free. There is some type of fee that is there, and it's often considered a yield. So then the short seller finds somebody that'll loan them the stock, they're paying the fee, well then they go out to the market and sell that stock at the current price. Now, yes, you need to be incentivized to allow your stock to be short, but there's also now a counterparty risk. If he just held the stock, and it just sat in their account and you're collecting a yield on it, great. But they're not going to just hold the stock, they're going to sell it. And that means that there's you want to get that stock back at some
So
point.
let's talk about what counterparty risk means. In other words, somebody else is holding that stock now. What if they fail and can't get the stock back or pay the money back?
Right, so I need some assurance that you'll be able to do this. So then that means there's a collateral requirement whenever you sell the stock short. So that collateral needs to be posted. Now, let's say we get to the next step. If we can get our, let's see. Eventually our PowerPoint will catch up. But the next step is that the stock decreases in value. So it worked out as the way that the short seller had anticipated. So the market decreases. And then what the next step would be, here we go, we finally are caught up and they're at our fourth step. This short seller now goes back out to the market, so they sold it at the high price, and they're coming back and they're buying it at the low, buying low, selling high, buying low, and they now pocket the proceeds, and then they return the stock and getting their collateral back to the original owner. So that's how short selling works, at least whenever the stock decreases.
So who actually holds the stock then? So if I'm short selling, which means that I'm going to borrow the stock and I'm going to sell it to somebody else, who actually holds the stock?
Well, let's go over what happens whenever the GameStop scenario goes forward, and then we'll get right into what's actually happening in the market. So we go through step one, step two, where we have collateral. But now we have this stock, and it doesn't work out the way that we expected, where now the stock increases. Well, remember, there was a yield that you paid, and you had a post-collateral. The risk of you being able to buy it back if the price is increased requires the collateral to need to be increased as well. And oftentimes, the person that has sold it short says, you're also going to need to pay me a higher interest rate. So now you have to either post more collateral or pay a higher interest rate, or your next option is to simply buy back the stock. Let's jump in and return that stock. The problem is if you buy the stock that you're short, and there's a lot of people having to buy this stock, you get the short squeeze where there's a feedback loop, and that's what happened with GameStop. So the more people that were buying the stock to cover their short, to not have to pay the additional collateral and the additional yield, causes the price to increase, causing more people needing to buy the stock, and then you just get this component. So
all of a sudden you have a bigger demand. So you're artificially creating a demand that feeds back on itself, which keeps pushing that price up.
Yes.
So what happens then at that point with the holder of the stock? Because, for example, we saw GameStop had to raise $2.4 billion.
Not GameStop, Robinhood.
Or Robinhood.
Right.
How does all that work?
So then that gets to the question of who's actually holding the stock, who's selling it short. In our opinion at Gatewood Wealth Solutions, because short sellers really get some bad press most of the times. The hedge funds actually got decent press this time, and it was the people that were pushing the stock up that got the bad press. If it was you, the individual, the owner of the stock, and you are the one that makes the decision to loan it out, you're the one that receives the interest rate, we think that there would be a lot of natural market forces that cut a lot of this nefariousness out. But that's not how it works. You can find a broker that will let you collect the interest, A lot of the ETFs will do this because they're going to sell the stock short and get the yield money for selling that. But it's often the brokerage firm or the broker that holds the stock. So Robinhood, Pershing, LPL, those
Schwab,
are
Fidelity, all of them.
all the clearing agencies are the ones that are actually loaning the stock out, rehypothecating the stock, and they're the ones that are benefiting from the interest. But that means that they're also the ones that are liable for posting a lot of the collateral.
There's an important point that comes out of this. In other words, the brokerage firm, Schwab, Fidelity, TD Ameritrade, Merrill Lynch, they're all making money on loaning out the stock that the customers actually own. So when they say that there's free trades, it's not that there are free trades. They're just making money in a different way.
Right.
I think that's an important thing for people to understand. And this whole race to zero, I want free investing, it's not free. So tell us more how this rolls out then in this picture.
Right. So to talk about that, though, I think a good rule is that if something is free to you, know that you're the product. So your Facebook, they're selling your information. It's not something that is a free service.
Right. In this case, they're selling your stock.
Right. Or the information on the trades. There is a link, at least. I haven't done deep analysis to make sure that it's not an urban legend, but I think this one is true, that the hedge funds do pay for the data from Robinhood so they can understand how to front run trades through high frequency trading. So that does happen. So know that if something is free, you're the product. So then that gets us to the next part, which is the myth, if we can get it to show up on the presentation, of Robinhood just hearts Melvin Capital, right? They had this nefarious agreement where they would stop trading because Melvin Capital is so powerful that they got to change the rules of the game to the detriment of all the Wall Street bets traders that were following the program. We would say that is myth number 2. So then, what was actually happening? Well, with the understanding that the broker is the one that's selling it, if we get into this situation, the collateral that the companies are having to post, so with Robinhood, it could be increased. Now they have to get money. And it's not that Melvin Capital made some calls and got this turned through, and maybe they did, but it wouldn't matter because there's actually a company out there called DTC or DTCC, which is, and also NSCC. And they're the clearinghouses of clearinghouses. Eventually I'll get this to show up here. The way that they work is they're the ones that are transferring the title ownership of a stock and making sure collateral is put up and money's there. And their whole purpose, everything that they do, is to ensure an orderly market. So that T+2, trade date plus true, that the stocks that you bought or that you sold have been transferred to the right owners, and the cash that you gave up or you're to receive came into your account. They are not concerned about what hedge fund is losing what. They are concerned about the operation of the market.
I guess you can kind of think of that like a title company.
Yeah, that's exactly what they are. Unless you hold your
title insurance, so you're just making sure that there's
every stock, even if I believe even if you were holding it, the physical certificates, which are almost non-existent at this point, will clear through this agency. And those that have CompuShare statements where their stocks are held through CompuShare because it's an employee, if you go and you want to make a transfer, you're going to go through the DSR system or the DTC system. So this is the very bottom of the stock equity system. It's in the basement, and it's important. They're the ones that determine when a stock needs to have more collateral requirement, because they know if someone sold short on a stock, there's going to be some that are not going to pay it. Either they're not going to be able to afford to buy GameStop. Remember, Melvin Capital had to go borrow $2.7 billion to pay down their shorts, or at least post additional collateral for their shorts, to ensure that they could buy that stock back and relieve their obligation. So it's there. They're doing that component. And this is probably what actually happened. Now, there's another component. So Robinhood had to go out and raise, let's see, I have it in my notes. How much money did they have to raise? I think it was $1.6 billion, right? And they had to shut their trading down that day. Because they didn't have enough collateral to continue to take on the liability of these additional stocks because the DTC and the National Securities Clearing Corporation said you're required. Now, then the conspiracy theorists would say, well, Aaron, that's fine, we understand this, but whenever they came back online, they only allowed people to have, not purchase, but own one share of GameStop and some other names within the account.
Okay? That sounds like a conspiracy.
It does sound like a conspiracy theory, and it certainly backs up that underdog's story. However, there's still more to that story.
What is it?
And that is there are regulatory rules with the, this is the state of Massachusetts. Let's see, we finally got the slide to pop up here. And in December, they had brought a suit and accusations against Robinhood that they were in violation of KYC or Know Your Client rules. Now, anybody that called in and said, hey, I want to buy GameStop, or those people, I'm sure you love doing that 6-question, it's no longer 11, 6-question risk profile questionnaire. These are all part of Know Your Client. And
so this is a rule that the regulators have put into place to protect the consumer. So in other words, that whoever is selling that security knows who the client is
and how much risk.
Right. Is this an appropriate security for this person to purchase?
Absolutely.
So does that apply in this case?
Well, yes, the regulator says it applies. Now, I think, in my personal opinion, if you're doing a self-directed account on one of these accounts, you got to have some liability on yourself, right? You're doing things on your own and not seeking out advice. So I don't think Robinhood, in my opinion, should be required to follow the Know Your Client rules. And that would actually hamper a lot of people's ability to participate in the market if you have to build your portfolio around the provisions that we build portfolios for wealth management, not concentrated speculative bets, right? So I don't think it's appropriate to apply it to Robinhood, but the regulators are the ones that say that it's appropriate. And with the amount of press that GameStop had been gathering, and they already have this accusation by the state of Massachusetts, it's likely that Robinhood said, hey, we know what's coming down, so we better put something in place that says we did something to protect people from themselves. Now, I lean more libertarian, so that's why I think that there's a little nanny. So they said you could only own one stock. Now, they didn't go in and sell it, and there were ways around this. So if you went out and you bought call options and then exercised those call options, there were ways to get around these components. But this is probably what is happening, not necessarily that Stephen Cohen had called up Vlad with Robinhood and they come to an agreement because he was losing, right? It's just that's probably not what happens, but it certainly feels.
It sells newspapers.
It does. And if I was a hedge fund, because remember, and we'll get to the monolith, if I was a hedge fund company and I would look at the price of GameStop at $350 and more, I would say, okay, how long do I think this is going to last? Because they were right. Melvin Capital is right to short this stock. Fundamentally, this stock is undervalued. And if I can make money at $50 and sell it short at Melvin Capital, I can make a lot of money at $350. As a matter of fact, I'll do everything that I can to promote a story of this underdog to get more people to buy the stock, to get the price higher, so I can short the stock at a higher price and then make even more money. So there are a lot of players that are going to be involved in a lot of angles. But the next thing that we hear is, these Wall Street bets, they're just rube retail investors, uninformed. They don't know what they're doing.
All those millennials with their $1,000 in their account.
What do they know?
Speculating on
and they bought Bitcoin. What do they know? I would say this is myth number 3, and animation still isn't working. Sorry, guys. But there are certainly individuals that have gotten into the game that may not know a lot about investing. And That's the nature of investing. Not everyone can be an expert in investing. They got to be experts in other things. Doctors should be experts in what they do in their craft. So we don't all have the time. But it is not true to say all of these guys are just basic retail investors. There are individuals that have very, very deep knowledge, and they're influencers. Now, because this is a wholesome market insight, we're not going to repeat the name they use for their I wanted to say Twitter account, but I guess it's their Reddit account and their Robinhood account because they don't have appropriate language. But if you were to Google Keith Gill and Wall Street Bets, you would see an individual who is a CFA that has a lot of experience running money for very big institutions. He works out of Massachusetts, and he's one of the big influencers. And if you go and you read a lot of the analysis, it's good analysis. They are not, these influencers have a lot of market experience. And what I would think about this is it's a new type of hedge fund. So you have these influencers, let's call them portfolio managers for a hedge fund. And they're going to go out and they're going to build their research, and they're going to crowdsource using everyone's information through these Reddit channels and really kind of bring together a good thesis and different components. Very similar to what a hedge fund would do. They would just do it in closed doors. And then you have people that are getting early in on and following this, maybe contributing some, but also building their portfolio relative to these influencers' portfolio. Those are the early investors or early clients. And then, yes, you do have, I think it went from 2 million to 7 million people following that subreddit last week. So you have the late investors. And you could say, well, this is where they're going to really offload a lot of these stock to the people. And that may or may not be true. I don't know that Wall Street Bets, I can't go into their head and say what is their motive. But this is not something that would be only a phenomena that happens here. Peter Lynch, his mutual fund, the Magellan Fund, one of the best performing mutual funds of all time. And he just was able to really outpace the market. And he's got books. I recommend reading his books. He really knows investing well and his approach. However, most of the people that invested in the Magellan Fund actually lost money because they were chasing his returns. They weren't in on early. But the
returns were skewed by the fact that there were significant returns early on in the fund. Mm-hmm. There was underperformance in the later years, but when you average it out, it looks great. So it's all about the timing of when you get in.
He did have returns that were great throughout his career, but a lot of people would come in at a high. He would go out of favor, they would sell out, and then he would come back into favor. So it was kind of timing that. So
that's all about that behavioral finance,
yes.
Where people fear when things go down and they abandon the strategy.
Yes. So let's see if we can move on to the next myth, and sorry, our stamp myth isn't showing up here. Maybe it is on the computer. The next one is that Wall Street is this giant monolith that are constantly changing the rules of the game. And I'm not saying that there is not things that go on that are not fair and that they're not questionable. There certainly are. But the idea that Wall Street is this one big block of people is not accurate. You have the IPO market where individuals or banks are going out to help companies get into the secondary market, meaning that they're a private company, not trading on the exchange, and they're going to take it and they're going to go public. And that is a vital part of the market process. If you own a private company, you want to retire or you want to raise capital, that's important. And that is different from the hedge funds who are kind of off in their own little world doing their different things. And there's a lot of different ways that a hedge fund is constructed. And they usually are actually as far away from the power centers of Wall Street as you can be, and they're doing that intentionally. Then you have the investment bankers at JP Morgan. They're doing their own approach. And then you have, let's say, the vanguards, where they're just getting market exposure. You have what we do, which is just wealth management for the retail investor. You have real estate. All of these players. And oftentimes, let's take the hedge fund. There may be one person that's short and another person that's long, and they certainly are going to try to squeeze the other person. And you may say, well, this is just a game. It serves no purpose. It does serve a purpose. Let's take the futures contracts. I think that one helps us really understand why speculation is actually good. If you're a farmer, you should be focusing your time on farming. not focusing on what's going on in the market. However, you have risks of your crop not actually arriving, and you're trying to sell it. So how do you? Well, you can go out and buy futures and ensure that you have something to deliver at the end of the harvest, whether you have something to harvest or not. So that reduces the risk for the farmer. But that means that speculator, and that's all they're doing, has to sell an insurance contract back and figure out a way to deliver corn from somewhere within the market. Or you could say, well, I need a certain price, and a farmer needs to lock in their profit. They got a crop going, so they want to sell their futures. And that's, once again, a speculator. So farmers can deal with farming, and speculators can deal with taking that risk from the market. And the same thing can be made with any commodity. So speculation has its role. One of them is also price discovery. So it's not a bad thing for speculation. We absolutely need it. Now, there needs to be some checks and balances. I think Adam Smith explained how those checks and balances could work within the market while allowing people to not have to be altruistic in their motives, that they could still be self-dealing. And for the most part, the market will operate in that fashion. Actually, having Wall Street Bets as this new alternative hedge fund probably helps stabilize the market over the long term, even though last week was anything but stable, especially for that stock.
Well, in summarizing the players in this, Reddit, Wall Street Bets, these are simply portals through which information is gathered through crowdsourcing. In other words, people are posting it. It's not limited to the research firm of Wells Fargo or Merrill Lynch or some hedge firm. That then is taken, and individual investors, and now we know in the millions, are going on to a trading site, which in this case, Robinhood. Mm-hmm. They're making the trades. Then there's the short sale. They're selling the stock. And that's where the risk. So they're carrying that counterparty risk, since the investors themselves are not actually holding on to the stock.
Right.
It's the Robinhoods, the TD Ameritrades, or whoever. At the end of the day, how do we see this impacting the market, rolling out into the future? We've heard this term that this is now the democratization of the investment world.
Yeah.
What does all that mean?
Well, democratization, it's a fun word, makes you feel smart, makes you sound smart. All it is mass production in a different form. It is bringing things down further to the person without having to have some type of monopoly privilege or a large amount of money. Think of the clothing world and buying suits. It used to be you had to go to a haberdasher to get a good suit. I don't know that Men's Warehouse is the first one to do it. I'm sure there were other stores that came to it. Well, they democratized the suit industry by mass producing and bringing it so that you didn't need to have a big pocketbook necessarily to get it. Or think of shoes whenever they came out. It used to be that whenever they first came out, everyone now had shoes. They could afford shoes because of the factory production. If you were of wealthier means, you usually still went to a cobbler to have your shoe made by hand. It was kind of a status symbol. So this is just a continuation of the Industrial Revolution of mass producing. Now it's getting to be about information more than just material goods, and it's that democratization where you're basically bringing down the cost so the masses can actually participate as well and compete with those that would have the hedge funds historically would have been the only ones that could afford the research, right? Well, now you can get on a Reddit chain, and a lot of people can share that research at a very low cost. So that's what democratization really is. It's bringing down the cost so the average person can get in it. So then the next thing is, what's the next scene from here, right?
What is the next?
And we can get to use that new animation. Hopefully that shows up on
It's pulling the curtains back.
That's right. Next scene, which when I put this image together, GameStop was just selling off, but we knew that this eventually would happen. We didn't know if it'd be at 500 or 1,000 or where the music would stop, but the music would stop. And if the only people that were buying the stock to push it up were people in Reddit and the people that were closing it once they ran out, there was nobody that wanted to actually pay $1,000 or $500 or $350 for GameStop. And yesterday it was down 60%, so it was trading below $100 for the day. Is this the end? Probably. We've probably seen the high in GameStop, but that doesn't mean that it can't start all over again. Because there are hedge funds that are probably taking short positions because it is fundamentally undervalued, and maybe we'll have another movement. But ultimately, the stock is, the best we can tell, it has secular headwinds that are just not going to go away. Most people, whenever they buy games, it's just a subscription. They don't go get the physical thing. It's in the retail space. It really was a stock that hedge funds were right to short. Now, whether they should have been able to short as much of it, that's another story, and that's where people like the Wall Street bets are helping identify the risks and the things where it's tilted in somebody's favor and removing that tilt.
Another place where we saw this was in silver, but it was a little different. Let's talk about that story because that's very.
But we would miss your favorite thing to talk about:
Which
passive investing.
Oh, passive investing. That's a great point because we're active managers. So how would we view this in relation to passive investing?
So it doesn't
Is it
look
helpful
There we
or
go.
not?
Here we go. So finally, got the slide to. Is it helpful? Well. It just shows that you need to know what you own. So let's say you were an investor in XRT, which is the Spider Retail ETF. So these are, I don't know that you call them big box, but at least a brick and mortar retail space. And it's not done well through through all the things, not only with the secular trend going towards Amazon, but then you throw in the coronavirus and the pandemic and the lockdowns. This has been a beaten down ETF. And whenever we're looking under the hood, all they do is passively own the stocks that follow that index. And as of December, whenever the ETF had closed out, GameStop made up 1.58% of the position. With the run-up, which you can see in XRT, that ETF, you saw substantial gains in that index, but it was all GameStop. So as of last Friday, obviously it's different today, GameStop made up almost 20% of the underlying holdings. So if you were buying XRT, whether you knew it or not, you were buying 20% of your proceeds were going into GameStop.
That's a high concentration.
It is a
in one
high
stock.
concentration in one stock, and it's not that the ETF is doing anything wrong. They seek to just track the underlying securities. So any additional shares, they have to go out and buy 20% of that into GameStop. But it just goes to show that you need to know what you own, which means if you have to get under the hood, oftentimes you're becoming an active investor. So this is part of the risk of that passive investing, and how the passive investor could be participating in something that they don't want to participate in. I think a lot of people, there's 7 million people following the subreddit. Well, that means there's nearly 330 million people that are not, right? And probably many people could see the writing on the wall there. So know what you own. Passive investing is not perfect. It has its flaws, and this was demonstrating one of those flaws.
Silver.
Silver. So the Reddit threads are now moving on to silver, and they're going to try to do a short squeeze. Well, there are differences here. One, it's not as easy to corner a market in silver as it was a fundamentally overvalued stock. So GameStop was fundamentally overvalued. If I've said undervalued for this, which I may have done,
You may have. I think you have.
I mean, it's overvalued. Don't buy it. It costs too much relative to the value of future earnings. So GameStop was overvalued. I think silver, you can make a really strong case that it's undervalued, especially if you do have concerns like we do, where we think inflation is a high risk.
Well, none of what we're saying is an endorsement to buy or sell.
Right.
This is something that you have to decide on
Right.
your own and consulting with your lead
Right.
advisor. But when we're looking at just from a pure economic market view,
Our view is silver would be undervalued, and it's a good position to have within the portfolio context, especially for inflation hedges that we see. So when we're constructing it, we like this position. It's far more difficult to corner the market. You have people that can bring in silver, whether it's recycling, whether it's mining companies that are sitting on it because they think the price is too low and they're waiting for a higher price to release the silver that they have in stock, whether it's the silver that you have at your home. There's a lot of ways that silver can come into the market that just weren't there for GameStop. Now, that doesn't mean the strategy that Wall Street bets isn't a good strategy on how they're approaching it. It seems to be a very good strategy. What they are doing, and over the weekend began to initiate, is they're trying to clear all the physical silver in the market out of the market and get it to what's known as strong hands, their own, which is in their house or in their safe. So there was over 10 times the amount of normal buying over the weekend. If you were to try to go out and buy a physical silver coin, which is trading in the high 20s to 30s, you will pay $40 an ounce to get that physical. So there is a big difference between physical silver and kind of quote unquote the paper silver that's out there. So empty the coin shops. That's strategy. That's
Think about how interesting that is, though, is that you didn't have some institutional player going in and just buying all the physical silver. This Reddit inspired millions of people to go out and buy very small sums of silver. And it made an impact.
It made an impact. It would be really hard to get it right now. You have to have, it's some of the bigger clearings that you got to have a $1,000 minimum, but only a $10,000 maximum purchase. So they're trying to deal with a squeeze. And the U.S. Mint has also said that that's one of the underlying issues right now is they haven't produced enough silver for this demand.
And then as the price goes up, these ETFs that own the silver have to go out and buy some silver.
Well, that's the second part of their strategy. So they're entering the coin stores, but now they're also going to SLV. And they're buying silver. And some people, especially those that are conspiracy-minded, would say, well, that's just paper silver. Okay, I guess it is. It is an ETF. You don't have the physical thing. But they have a really strong auditing process that makes it unlikely that it's only paper money or paper silver.
How do they do that?
So as you put in more money into the ETF, and they need to go purchase more silver in the market. And when they bring a bar in and they assign it to a basket in the ETF, they have a serial number. And those serial numbers are posted. Could they be lying? They could be, but man, that's a pretty strong auditing process. I would venture to say it's stronger than GLD's auditing process. So that means the second part is not only are they emptying the coin stores, now any of that silver that's typically coming onto the market is getting bought by an institutional player, SLV, or the iShares SLV, and they have a really good auditing process. So that is probably pulling even more physical out of the thing. And then the final component to it is that they're taking long contracts in silver futures. So they're going to the Chicago Mercantile Exchange. Yesterday's sell-off was probably, in silver, was probably related to the increase in margin requirements that the CME placed on silver. Now, this is very similar to the DTCC putting the collateral requirements higher on GameStop. This is not them being nefarious. They take market risks. If people can't honor their futures contracts, they are going to be the ones that step in. So they have a business reason and a business risk to increase this.
It's that counterparty risk that we were talking about before.
So it doesn't necessarily mean they're being nefarious or trying to keep the price of silver down for any other reason other than their own interest, because they are the ones that are ultimately on the line if these contracts don't go out. Well, those people that are buying it in the Reddit threads are going to demand, at least they say in their Reddit chains, physical delivery of silver. They're not going to accept cash. So that means that if the physical silver has been basically sucked out of the system and you need to go buy physical silver for delivery, and there's actually a lot more contracts that are trading than there is physical being created, this could create a bigger spike in physical. Now,
again, this is an artificial creation of demand,
yes,
and shrinkage of supply.
So then this can be a systemic risk, because those people that are short those contracts are actually the investment banks. J.P. Morgan is one of the bigger ones. So it could arrive into the economy where we didn't think GME, the GameStop, really could have a big impact on the economy. This could show up, and we'll be watching it. Once again, it would be really, really difficult to actually pull this off. The Hunt brothers tried to pull this off back about 3 or 4 decades ago, and it didn't end well from them. No. Final myth is that all of this is the fault of evil speculation, which serves no purpose. And I think we've talked about that, so we can say this is a myth. Once again, there's a lot of players here, and ultimately, if you want to find who's to blame for this, I would say it is the Federal Reserve, with the amount of money that they have created So we have $4 trillion of additional money that is out there. I wish our slides would work here. And that is what's causing extra money to slosh around, to the point that if you go into those Reddit chains, you see they call them stimmy checks. They took the money that they received from the government, put it in their Robinhood account, and that's the money that helped them speculate. And why wouldn't you? It was essentially free money. You could lose it. What's the difference? There wasn't any working component behind it. And then also, it's not just this one time. The Fed has stepped in time and time again to help keep stock prices higher. They've talked about their money bazooka. So there's also a false sense of security that that these prices will only continue to go up, especially if you're a millennial. That's all that's ever happened since a crisis is that we've printed money and it's elevated. So I would say the blame, if it's anywhere, it's the Fed tipping the field in favor of prices continuing to go up and giving a lot of people a lot of money to speculate within their investment accounts.
That reminds me of a conversation that I had yesterday, which feeds into our theme about inflation. So we were sitting with our banker yesterday, and they were talking about how their plan for this year was to end with $425 million in deposits. They actually ended up with $525 million, so $100 million more. And the loans are being paid down. I said, well, what is that phenomenon? He says that so many companies have received the PPP, the EIDL, but they don't want to invest because they're not sure what's going to happen going forward with taxes, with regulation. And then you have these people that have deposits there that are maturing, but they don't want to go into the bank to take them, so they're building up cash. So that means that there's money sitting on the sideline that can be highly growth oriented, inflation driving, and will continue to push those asset prices up.
Yep.
And those haven't even been accounted for. And he said this is not just his bank, this is a national phenomenon. So it'll be interesting to see how that rolls out, but I certainly think that plays into our theme of inflation going forward.
No, whenever we look at the market, it was down last week. It bounced off that 50-day, which is one of the areas that we had as resistance. It has since recovered and gone back to its trend line. So we'll continue to monitor these price points. For people that are dollar cost averaging, we wouldn't say that this has been a dip to add any tranches or anything like that. Just continue to go as planned. The dollar continues to rally off of its recent low. That's not surprising. It's never a straight line. And then whenever we look at those gold to silver ratios, when people were asking, hey, should I have physical silver? We were saying, or physical metal, we said yes, right. For that time being, we were saying, have a little bit more emphasis on the silver than the gold when we look at the ratios. With the recent rise in silver prices, they've kind of come back to more normal ratios. So if you are going to buy precious metals, talk to your lead advisor, but an equal amount in both at this point. And then if we look at our relative strength, we continue to see small cap being the highest. We see commodities rising. We did make a trade. Basic materials in tactical mutual fund was weak based on its signal, and we did increase slightly our exposure to commodities, which have continued to be the area that starts to heat up, especially the lumber and oil and some of the other factors. When we look at interest rate, the 10-year has kind of slowed on its appreciation, but that doesn't mean that the spread has changed much. We're seeing similar changes elsewhere in the curve. And what this means is what you were talking about. Banks will have an incentive to loan the money out. And to your point, the deposits have grown substantially since the last year with all the money that has been injected into the system. So there's a lot of dry powder that could be loaned out with the multiplier effect that could have that impact on inflation. So,
very good. Well, we are out of time. So thanks again for your presentation today. I thought that was very interesting about the whole GameStop phenomenon and really understanding the different players in the market, because I think a lot of people really aren't aware of how the structure works.
It's very complex.
It is very, very complex, and that's why it's important to have someone like us, where we have the ability in the research team to really look under the hood to understand what's happening.
Yes.
So thanks again for joining us today, everybody. As you know, our goal here is to provide you with data-driven information so that you can be better informed about your portfolios and when making decisions around your hard-earned money. So we look forward to having you back next week, and if you haven't already, please subscribe to our YouTube channel at the button on the right side of the screen.
Right below you.
I never know which way to point my fingers. And if you'd like to learn more about our firm or you'd like to speak to your lead advisor, please call the number on our screen, 314-924-5100, and we look forward to having you back again next week.